here. We're doing chapter 5, which is over the balance sheet. And you guys have been to the board and you've started out with what you remember from the balance sheet, right? We're doing a classified balance sheet, which we said before, it's classified based on liquidity and how close it is to cash. Okay, so the main categories, well, first, let's just make sure that we remember the balance sheet equation is assets equal liabilities plus stockholders' equity, right? And you guys have listed the assets on this side and the liabilities and equity on this side. Okay, so we've got a good start here. The classification, well, so these things also, remember, these things right here are named a specific thing that we covered, I think in chapter 2 maybe. These things are called elements. Remember that? Elements. Okay, so assets, liabilities, and stockholders' equity are elements. Remember some of the other elements were expenses, gains. Do you remember that? Gains and losses, revenues and expenses. Okay, so these are the elements that are on the balance sheet. And we did kind of talk about, back when we studied elements, that what the definition of an asset was. Okay, so it might just be helpful to look at that. Probable future economic benefits obtained or controlled by an entity as a result of past transactions. So to record an asset, you have to have a probable future benefit. So like cash being an asset, it's an almost certain future benefit, right? You can use the cash in your business to buy something. But accounts receivable is probable because there's also an allowance for doubtful accounts associated with that. So, you know, you're not for sure going to get actually any cash from that accounts receivable, but you probably will, okay? So, and you'll be able to use that in the future. Okay, so now on page 217 would be something that would be very helpful. No, 216, let's look at page 216. And these are the classifications on the balance sheet, okay? So particularly look at your side and see what classifications there are on the assets or what classifications there are on the liabilities, okay? So are there any adjustments y'all want to make to your deal there? It looks like on the assets you have, you've called it short term, right? Do you want to adjust that in any way? Current assets, okay. Now we won't, worry with what's under current assets. Now, what other assets are there? What other types of assets are there? Okay, well, y'all got long-term assets, right? You have that one. Intangible assets, where do they go? Near the bottom. So we've got current assets, long-term, well, they call them long-term investments. Maybe that'll be a fine way to call it. Or you could really call them long-term assets, to be honest. Then property, plant, and equipment. You don't have that really separated out, but maybe right here we have property, plant, and equipment, right? Let's just put it right here. Property, plant, and equipment, PP&E less depreciation. Okay, how about that? And then after that comes intangible assets. You didn't really list any of those out, but we'll get to that, right? And long-term investments. Okay. Well, now that's kind of got that whipped into shape, right? So how many categories do we have? 5. 1, 2, 3, 4, 5, like that, right? No. Which one am I missing? Current, long-term, property, plant, and equipment. Oh yeah, other assets. Okay, so 5 categories, right? How about you guys in the liability section? How did y'all do? Anything to add? What are the liability categories? Current, okay. So current liabilities. And then what else? Long-term liabilities? Long-term debt? Okay. Okay, so we could call that owner's equity, stockholders' equity, something like that. Okay, so it looks like now we've kind of got the basic categories. On the liabilities and owner's equity, there's 3 main categories: current liabilities, long-term debt, and equity. And on this side, there's 5 different categories, okay? So don't you think this will make it easier to remember since y'all were struggling a bit? Now you can say, oh, yeah, now I remember. I think it's just easier. A lot of times you have to kind of not know what you're doing before you really figure out what you're doing. Okay. But what we're going to do today is really just fill in all of these categories. Okay? There's more, there's more things listed under current assets than what you guys listed, right? So we're just going to look into that. Now, we did talk about what makes something a current asset. And we have in general said, well, they're listed in order of liquidity. But what makes things a current asset? What's our general cutoff for current assets? A year. That's our general cutoff, but it's a little more complicated than that, isn't it? Okay, a year or an operating period. So there's one more step to that, an operating cycle. Okay, most companies' operating cycle. What do we mean by operating cycle? Like for a general company, an operating cycle is we have cash. What do we do with our cash? We buy something to sell. So like we buy inventories. We sell those and get accounts receivable. And then what happens? It turns back into cash. And then we start all over again. This is an operating cycle. And it even could be more complicated than that. We buy cash, we buy raw materials, we make our inventory, and then we sell it and get cash. Okay, so that's an operating cycle for a business, kind of like you learned in management or something. That's a cycle. For most companies, how long is this operating cycle, would you say? Let's just say for Walmart. How long does it take them from whenever they have their inventory to sell their inventory? How long do you think things sit on the shelf at Walmart? Two months? Is everybody happy with 2 months? And then how long does it take them to get their cash? From the time they sell it to the time they get the cash, how long does that take? Right away, like a few seconds, right? Because it goes right to some bank account. It just happens right away. Okay, so really, how long does it take them to buy their stuff and receive it? Hardly just a couple of days or something. So really, they probably have a 2-month operating cycle, right? And so a lot of businesses, that's really important because you don't want your stuff just sitting around in inventory, right? You don't want to, Inventory costs money. And then a lot of times you have to borrow money to buy the inventory. So now you're paying interest on how long it sits. So this is kind of this is an inventory turnover ratio too. I mean, there's ratios that you can compute on how fast inventory turns over. But we're talking here about the operating cycle. Some companies have a longer operating cycle, such as, name a company with a long operating cycle, longer. Walmart probably has one of the faster ones. Maybe grocery stores have really fast ones. Who has long ones? Jillian. Who has a long one? Boeing, yes. Okay, excellent. Okay, so a plane company. So I don't know if y'all knew that, well, maybe I won't say. I know someone who works for Boeing, so that's kind of neat. Maybe I shouldn't say who it is. Okay, so how long is their operating cycle? From the time they have the cash to the time they make their inventory to the time they sell their inventory. How long would you think, Jillian? Approximately. Over a year, okay. So maybe even 2 years. I mean, make a big plane, that takes a long time. Or, people that make big, tall buildings, long time for that too. So that would be over a year. Okay, so going back to our definition of what is a current asset, or when do we cut off current versus long term, the definition is 1 year or the operating cycle, whichever one's longer, okay? So for most companies, the definition is 1 year. It's only for a few companies like Boeing that it's longer. I'm going to say, some car companies, they have a longer one too. Like the car might sit on the lot for 4 months, right? Or 6 months even, 4 to 6 months. So, but that's still not approaching a year. Most companies really don't, they want to sell their goods faster than that. Or how long do diamonds sit in a store, in a jewelry store? They might sit there for several months, much longer than at Walmart. Okay, but maybe, hopefully not a year, unless, the Hope Diamond or something. But okay, so that is, now we've done kind of the different categories. And we're measuring how long it takes companies to convert things to cash. And cash is like the shortest term of all the short-term assets, right? In the next, well, not the next chapter, but in chapter 7, starting in chapter 7, what we're going to do is march down the balance sheet. And we're going to do that for the rest of this class, and then half of Intermediate 2 will just be going down the balance sheet, down all the way down the assets in order, and then down here in order, and take more detail. So chapter 7 is going to consider these items right here, cash and accounts receivable. And so cash, we're just going to go into lots of detail as far as what cash is. What is cash? What different types of cash are on the balance sheet? And you might think, well, it's pretty easy, self-explanatory what cash is. What's cash to you guys? Paper money, right? Do you count pennies in that? Pennies? Okay. Well, so change is also cash. And then what other kind of cash do we have? I don't know if y'all even have these anymore. Checks. I have, I write a check about every 5 weeks maybe or something like that. I mean, I hardly ever write checks, but checks are cash too, for a company. If they have some checks and they're undeposited, then that's cash. Okay, but the thing specifically that we want to talk about in this chapter is we have what's called cash and cash equivalents. Ordinarily, cash is something that is immediately spendable But cash equivalents are things that aren't spendable right that second. They're not entirely liquid, but they're within 3 months of being cash. So that sounds a little bit weird, I know, but it's kind of like a money market bank account. Are y'all familiar with these? Well, in the bank, what's called a money market bank account is a little bit different than a brokerage firm money market bank account. But they're highly liquid, short-term investments that mature within 3 months. So a lot of times, companies, if they have excess money, they have a choice of what they're going to do with it. They can go buy a CD, they can go invest, buy some stock. But if they want to keep it highly liquid, a lot of times what they do is buy some kind of short-term investment, or they can buy some kind of investment fund that has only things that mature within the next 3 months. So what's an example of that? Some kind of treasury. So companies, part of the job of the finance officer is deciding what to do and how to invest their short-term money. Rather than cash, ordinarily just cash sits there and makes no money for you. But if you have a lot of excess cash, then you might put it in a cash equivalent. Okay, so one other point is, so let's just add this. Let's just add this right here. Okay, and let's put cash up here and add cash equivalents right there. And just know that these are within 3 months, okay? All right, so the next thing that we're going to talk about is restricted cash. Restricted cash, and we'll put it right here. Okay, so restricted cash is cash that the company cannot use right away. It's restricted for a certain purpose. So a common thing is that if a company borrows a lot of money, like borrows money in the form of a bond, then one of the terms of the bond might be that they have to save money to pay that back at the end. Okay, are y'all familiar with bonds? Bonds have 2 parts. One is that you have to pay interest back each year or twice a year, and the other part is you have to pay the principal back at the end of the term. Do you see what I mean by that? So a company has 2 choices of how it's going to raise money, either by issuing stock or issuing bonds. If they choose to issue bonds, they have to pay that money back and they have to pay interest. The interest they pay once or twice a year, the principal they pay back at the end of the term, okay? So one of the conditions of bonds sometimes is that the bondholders demand that they keep cash on hand for the purposes of paying back the principal or interest. And that would be one type of restricted cash. It cannot be used for any other purpose besides paying back either the bond or buying some kind of expensive equipment, or there be some purpose that the company has restricted that cash for. Okay, so why do we separate out restricted cash from cash? Do you see how the users of the financial statement are assuming that cash can be used for current operations, and restricted cash cannot be used for current operations? So that's why we separate it, to let the investors know that to separate out these 2 amounts so they know how much can be used for operations. All right, so I see some of y'all are writing these things down. I would highly recommend this and leave some room, because at the end of this, we're going to be adding these as we go along. This is what this chapter is about. If you don't know these things, then you're not going to know this chapter. This is it. All the stuff that's on the board, that's what you need to know. Okay. Okay, so the next section is short-term investments. Okay, so short-term investments, there are three. This discussion is a little bit one of the hardest things in the chapter. Short-term investments. Okay, so we're going to talk about this right here. Okay. Like I said, when a company has excess money, one thing it can do is just let it sit there in cash. Okay, that's the equivalent to hiding it under the mattress. How good is that? How happy would the stockholders be if you just hid your money under the mattress and earned no interest? Not very happy, right? Another thing they could do is do cash equivalents, which would be less than 3 months, right? Okay, or they could invest their money in what's called short-term investments. Okay, so investments are required to be grouped into 3 separate categories. Okay, so let's just say that investments can be in 3 separate categories, and those are on page 218. Like I say, this part is a little bit complicated. One of them, I'll always like to start at the middle one, these are trading investments, okay? Trading investments are investments that the company intends to sell right away in order to make a profit, okay? So their intent is to sell them. They're called trading securities. Okay, so these types of investments can be debt or equity investments. What do we mean by that, debt or equity investments? What's the example of an equity investment? What does that mean? Stock. Okay, so yeah, equity investments are stock. What are debt investments? Notes or bonds. Okay. In this case, we're really primarily talking about bonds, I think. But, okay, so debt or equity investments. So if you're buying a trading investment, the way that you can tell these 3 categories apart is you can say to management, what is your intent? And if they say to you, my intent is to sell these, I don't want to hold them, I want to sell them soon, then that makes it a trading investment, okay? Now, on the other hand, we have hold to maturity investments. Now, how can you tell something is a hold to a maturity investment? You say to management, what is your intent? And they say, my intent is to hold these things until it matures. All right, can you look at the investment and tell the difference in these 2 things? No. You have to ask management, what is your intent? And management could, literally change their intent. At any time, really. They could change their intent. And the thing is that management intent dictates where it's going to go on the balance sheet. Okay? Trading securities, trading investments that you're going to sell right away, these are current assets. Okay? So we could say right here, trading investments go right here in current assets. all right? Out of the three categories, trading investments go right there in current assets, okay? Now, why is that? Because we intend to sell them. That intimates it's going to be within a year, it's going to be within the next year. We intend to sell them right away. Okay, then the reason is, why are they investing this money? To make money. That's their intent here. Okay, held to maturity securities, since we're going to hold those to maturity, should they be short-term or long-term? Long-term, because the maturity is when? When's the maturity? Do you know that, Kyle?
Far away.
Far away?
Yeah.
Could it be next month, the maturity? Possibly, right? So do you see the problem? It depends on the maturity, okay? So it can be short-term or long-term, most likely long-term, right? But short-term or long-term depending on maturity. So you have to know the maturity date to say where those should go. Okay, so you see what we've, this is the shortest amount of time you can hold something. And this is just about the longest amount of time that you can hold something. But there's some other things called available for sale securities. So available for sale securities are somewhere between these two. We don't intend to sell them right away, but yet then we don't intend to hold them to maturity. They're just kind of in between. As a matter of fact, their definition says they're not classified as held to maturity or trading securities, right? That's the only definition. They're somewhere in between those two. And so these also can be short-term or long-term, just depending, or current or long-term. So now we've kind of seen whether these things should be a short-term asset or a long-term asset, and we know that trading investments are the only ones that are just definitely going to be short-term, right? But there's one more thing that we need to know, and that is, how do we value these? So what value do we carry them? What's our carrying value on the books? Most things on the balance sheet, typically, what is our carrying value on the books? How do we value things normally? Historical cost. But for these, since they're investments that are in some cases very close to maturity or very close to being sold, we kind of move away from the historical cost principle. And in fact, the balance sheet is in general, let's just say, in the past, couple of decades, the accounting has moved kind of away from historical cost and a little bit closer to market value, which is kind of the opposite of historical cost, changing everything to its market value. Okay, so these assets, trading investments that we're going to sell right away, how important is its historical cost? Not so important. What is the more important thing? What it's worth right now. Okay, so those trading investments are valued at fair value. We value these at fair value. What does that mean? That means what you could sell it for right now. Really, that's what it's worth right now. It's fair value. In other words, it's market value. Okay, so available for sale securities, since they're so trading securities, since they're so short term, they're valued at fair value. Also, trading securities, seeing as how their intent is to be sold soon, they're valued at fair value. And held to maturity securities are valued at amortized cost. Okay, So there's a lot to remember on these three items, right? Kind of to remember what the definition is, to remember whether they should be current or long-term, and to remember how they should be valued at fair value or amortized cost. But I think that it helps to put them in order, in this order, to kind of remember them, seeing as how these are going to be sold, sooner than these down here in the held to maturity section, okay? So that is a lot to remember on that. Okay, so the next thing after the investments is receivables. Okay, so we have accounts receivable here, less allowance for doubtful accounts. Okay, so on the face of the balance sheet, companies are required to disclose how much they anticipate is uncollectible. And that's what the allowance for doubtful accounts is. And usually in the notes, they might divide up in their accounts receivable into different categories, like that shows you some different kind of categories there. So accounts receivable, like I said, we're going to have a whole chapter on that, but as far as for this particular class, it's not that complicated. You should, one thing is accounts receivable is typically thought to be trade receivables, meaning, or primarily it's trade receivables that you get in the course of your business, from selling your goods. If you have some other big receivable, you should disclose it separately, like officer receivables, or employee receivables, or receivables from another company or something like that. They should be disclosed separately. Okay, so inventories. Also, while we're talking about how things should be valued, on page 217, it tells how all of these things so far should be valued. Cash and cash equivalents are valued at fair value, which is usually the same as not much different than historical cost, to be honest. And receivables are valued at their amount that's collectible, right? And this is what this allowance is for. And inventories, and this is why I'm bringing this up, inventories are valued at, how do we value them? Inventories? FIFO, LIFO. Then there's some other, do we value them at cost? Lower of cost or market. Okay. So we put them on the books at cost. So let's just think about what this means. When we buy something and put it in inventory, it's in the books at cost. But then if it turns out that the market value of the inventory is lower than its cost, we have to write it down, right? You know what I mean. So like Walmart buys its inventory, puts it in there at cost. Most likely they're going to sell it for more than they bought it for, right? And it's worth more than they paid for it. But if for some reason they have some item that they haven't been able to sell and it's just not worth as much, then they're going to have to write that item down to market value. Okay, so inventories are at lower of cost or market, and we're going to have 2 whole chapters on inventories. Sounds like a lot, right? 2 whole chapters. One's going to be at the end of this, going to be the last chapter we cover in this class, and one is the first chapter that you cover in Intermediate 2. Okay? Okay, so they're at lower of cost or market. And then I'm going to go ahead and put prepaid expenses down here. And prepaid expenses are valued at cost. Okay. Okay, but let's continue on the inventory train. They're lower of cost or market is how we value them. The cost flow assumption that we use is FIFO or LIFO or whatever like that. So just to get that terminology right, FIFO or LIFO is the cost flow assumption. That's how we come up with the cost part of it. And then the basis for valuation is lower of cost or market. Okay, now let's talk about what kind of inventories there are. So let's list them right here. Inventories. So far, we've just kind of said, well, inventory is inventory, right? But you might remember, like from Principles 2, that there's a way that things go through inventory. When you first buy the raw materials, that's the first thing. If you're manufacturing your inventory, you're going to buy the raw materials, right? And that's called raw material inventory. I'm just going to abbreviate it. But raw material inventory, or what they call it, is materials, okay? So that's the first place that things go. And then the next place is work in process. As you start working on the inventories move from raw materials into work in process. Then when you finish making the inventory, it goes to finished goods inventory, right? So that's the step 1, 2, 3 that it goes into. So that's something that you disclose on the balance sheet, those 3 items. And it could be, if you're a company that manufactures things, that could be how you show inventories. Or if you don't manufacture your inventory, if you're a Walmart type company, then you'll just have something called inventories. Okay. All right, so now we talk about prepaid expenses. Prepaid expenses are at cost. They're normally short-term. Kyle, I guess you'd say, how prepaid expenses, they're short-term, right? But could they be long-term? They could be long-term because depending on if you're going to get a benefit for longer than a year, then there might be a part of it that's long-term. Okay, so it could be that you pay for your insurance policy 3 years in advance instead of 2. So we're assuming here they're short-term, but there could be a time when they are long-term. But we put the current part of it. This is very important. In any of these cases, I mean, we want to put the current part up here and the longer part, if there is a longer part, at the bottom. Okay. All right, so we finished current assets. Okay, we're doing okay. Now, now we're going into long-term investments, which could be investments in securities or bonds, or it could be long-term notes. There's a lot of different sort of investments that are in long-term investments. Y'all have notes receivable here, so that's pretty good. Because notes receivable are generally long-term, right? You made somebody sign a note because they are long-term. So if it is a long-term receivable, then put that in long-term. Okay. All right, I think that's enough on that for right now. And then property, plant, and equipment. So property, plant, and equipment, one of the key things to remember here is that these are things that are used in operations, okay? So this isn't just because it's land, it goes in property, plant, and equipment, or just because it's a building, it goes there, but we put it there only if it's used in operations. Now, why would you have land or a building or something else if you weren't using it in operations? Why would you even have it? it's an investment, or maybe you bought it intending to use it in the future and then you decided not to, or whatever. So this is intended just to be, or this is to be, only things that are used in operations. So the different types of these are usually the way that these are listed, and the order that they're listed in is land. Well, actually, they're not always listed in that order, but anyway, we'll go with it. Land, building, machinery and equipment, and maybe even automobiles. Could even be a separate category in there. Now, another thing that in this one in the book on page 222, they mention capitalized leases. So this might be a good time to talk about capitalized leases. Do y'all have any idea what that is? Do y'all know what a lease is? Have you ever leased anything? Has anybody familiar with a lease? What kind of things do you normally lease? Oh, you could lease a car. Companies a lot of times lease cars. Sometimes they lease copiers. Instead of buying a copier for $8,000, they lease it for $200 a month, Now, in a lease, let's say, Kyle, for the car lease, do you normally own the car at year end? No. Do you have the option to own the car at year end? Yes. So sometimes you own it. Sometimes you could own it if you wanted to. What is it? Why don't people own their car at year end a lot of times? Because you have to pay a lot for it. Or maybe they just choose not to. They'd rather lease another car, right? But companies lease things for all different kind of reasons, one of which is that they'd just rather pay short-term payments. But another might be they don't have enough money to buy it, okay? But in a lot of times in companies, when they lease things, a lot of times the thing that they lease it for 5 years, and at the end, they can buy it for $500. It might be a big piece of expensive equipment, and at the end, they could buy it for a small amount of money. So the amount of money that you could buy it for at the end kind of helps determine whether it's which type of lease it is. We see here that we have capital leases. What's the opposite of that? What's the opposite of a capital lease? It's a specific term, and it's in your book. Which chapter is leases? You have a whole chapter on leases, I think. I think it might be in Intermediate 3. See which chapter that is for me. Is that it, Brett? No?
Chapter 21.
21. Okay, so chapter 21 is on leases, so that would be in Intermediate 3. And then in that chapter, we're going to determine how to tell whether something is a capital lease or an operating lease. In a capital lease, what do you do with it? You put it on the balance sheet as an asset, and you depreciate it. So what is your assumption, would you think? Are you going to buy it or not? You would buy it at the end. It's kind of like this is the type of lease that you are really buying something, and instead of borrowing money to buy it, you're leasing it. And then at the end, you're going to pay a small amount and get it and keep it as an asset. Okay, so the opposite of that is an operating lease. And an operating lease, where does that go? What does that kind of indicate to you? That is the kind where you're paying monthly payments, and at the end of the lease, you're going to give it back to them and you're done with it. So what do you do with these monthly payments? You expense them on the income statement. So an operating lease does not go on the balance sheet at all. The monthly payments go on the income statement. And in a capital lease, the monthly payments are not expensed. because we're using depreciation to expense this thing. The monthly payments are just a financing mechanism, okay? All right, so that is property, plant, and equipment.
So if you only put stuff on the balance sheet that you own, like
Own or control, because
Capital lease.
an example of something that you control, rather you don't own a capital lease thing, still the lease company owns it until you pay that last payment.
An operating lease, there's no need to put that on there because you're never gonna.
You don't intend to own it ever, right?
if you're the person writing the lease and you write an operating lease, that would, if I were to lease you out a car on an operating lease, I would put it on my balance sheet.
It's on your balance sheet, not mine. It's usually not on two people's balance. I mean, it wouldn't be on two people. Only one person really controls it, you know.
The capital lease, you would put it on yours, and I wouldn't.
Yeah, that's right. Okay. So I guess we are to I skipped a page, right? I skipped in, no, I didn't skip intangibles. Intangibles, they're coming next. Okay, intangible assets. Okay, so name me all the intangible assets that you know without looking at your book. Copyrights? Any others? Julian? What's that? Huh? Oh, goodwill, yeah. What was the other thing you said? Oh, okay. Oh, okay. Okay. So what is goodwill? What is goodwill? Oh, okay. That's why you're saying charity? Yeah. Yeah. So forget the goodwill like that has the clothes and things like that. Okay, forget that part. It's in a company, goodwill is when you pay more for if you were to buy a company, let's just say one company buys another company. All right, y'all focus on the goodwill part right now. When one company buys another company, it puts the asset of that company on its books at cost. So let me give you a good example. Let's say you are a new dentist and you buy a dentist office, okay? What are the assets of the dentist office? The building, the equipment, the furnishings, right? You put all those on at what their value is. Have you paid more for the dentist office than those things? Would you buy the dentist office for more than the building is worth? No? So y'all are saying, well, no, why would I, right? Well, why would you is because when people buy a dentist office, the people that went there 6 months ago, they're just going to keep sitting in that chair. And they're just going to keep coming for years and years, no matter who the new dentist is, right? There's some kind of value in the fact that there's a whole big old customer base.
Just like a trademark.
It's kind of like a trademark, but it's the amount that you paid over and above those to get the customers and stuff. But it's something that you can't really identify. Goodwill is not like a trademark that you can really identify that it's a certain trademark, but it's amount. It's when you buy a business, it's the amount that you paid over the asset value, okay? So, all right, so did anybody else think of any other intangible assets? Oh, you said trademarks and patents. Now, whenever you form a new company, like let's say you're who was it Asa Candler that created Coca-Cola, or was there somebody else? Back in the day, you're whoever it was that created Coca-Cola, you're going to hire a lawyer to file a form to protect your trademark, right? So for Coca-Cola, what things are trademarked for Coca-Cola? There's several things. The shape of the bottle, which that's not too good. The way Coke is spelled, just the way this goes, that's trademarked. The shape of the bottle is trademarked. The little kind of curly thing that goes after Coke, the way everything's written, all of that is the patent has to do with the formula for Coke, is patented. The formula for Coke is kept in a vault in Atlanta, where nobody can get to it except for like these certain few number of people that know the combination. So it's very, hush hush secret. All of this. Well, the lawyer that you paid to trademark that stuff charged you a fee, and you had to pay a filing fee. And so that amount, the cost of that trademark, is then intangible assets. Okay, and the copyright. Anything else that there's probably some more that we have not listed. Patents, trademark, franchises. What's a franchise? For McDonald's, let's say. What is a franchise?
Someone else owns the local business?
Yeah, somebody might own the local McDonald's here. Well, who owns it? I don't know. Somebody owns it. And what did they have to do to own it? Pay a fee. I mean, the fee to buy a McDonald's, I would say it's probably $250,000, something like that. Do you think that's right?
I've heard someone else.
Yeah, I think it's around that much. And like other smaller things, like if it's a Subway or something, it might be more like $150,000 or $100,000, something like that. So if you want to own a bit, why would you pay $250,000 just for what do you get for that? You get to put McDonald's out on your sign. You also are required to sell certain kinds of meat and certain items in a certain way. And then you also have to give them a % of your sales. Everything that's sold, a % of that goes back to the franchisee. Why do you pay that? Because otherwise, if you just started making hamburgers, nobody would want to go to your place. They'd want to go to McDonald's, right? So it gives you instant credibility. So people are willing to pay for that. That's some kind of asset. So, it's an intangible asset, though. They have some kind of value, these assets, but it's not something you can touch, right? Okay, and then other assets, there's a lot of different things that might go in other assets. Okay, so now let's look at the liabilities section, which is much easier. Current liabilities, we've kind of gotten a good list here. Accounts payable, notes payable. Are notes payable, you want to put it down here? Okay. Notes payable, are they always long-term? Are they always long-term? Kyle?
Yeah, most of the time. I would think.
The year that they mature is
Whenever they mature kind of helps decide it. Most of the time, you're right, most of the time they are, but not always, okay? So if notes payable are due within the next year, they should go up here. So if it's notes payable due within the next year, it goes right here, which you might definitely have a note payable due within the next year. So we have interest payable, taxes payable, wages payable, a lot of different payables, right? Okay, those are all current assets. Liabilities. Now, there's one thing associated with the notes payable that's important. Okay, so a lot of times, if you were to sign a notes payable that is a 10-year note payable, a lot of times they're going to make you pay a little bit of that every year. Usually once a year you have to make a payment on your long-term note payable. Do you know what I mean by that? Even though I bought a house and it was a 15-year loan, do they just say, okay, we'll see you in 15 years? No. Right? And same with notes payable. They don't say, oh yeah, thanks, and I hope you can pay me back in 10 or 15 years. There is a payment that you're going to have to make, a current payment, usually on the note payable. So what we call that is current maturities of long-term debt. And this is a current liability, and it represents the amount of the long-term debt that will be due within 1 year, right? What's due within the next year. Now that's something that I don't even think y'all have talked about that yet, right? Is that something new? Ever seen that one before? Okay, so that's something new. So that's something, that a lot of people get crossed up on. That's the reason I assume that you haven't seen it before, because a lot of people get crossed up on that. Current maturities of long-term debt go in the current liabilities section. Now, one thing that it's very important whether you put things in the current assets section or another section, because there's a lot of ratios and formulas that have to do with current assets and current liabilities, okay? So it's very important for a company it's very important to companies for purposes of borrowing money or for their liquidity purposes that their current assets are more than their current liabilities, right? For you guys, wouldn't you think it's more important that your current assets be more than your current liabilities? Like your cash and accounts receivable and all that, to be more than what you owe within the next year? Yeah, because, the difference in your current assets and your current liabilities is called working capital. So current assets minus current liabilities is what's called your working capital. But there's also a ratio that's current assets divided by current liabilities, and that's your working capital ratio, current ratio. Current ratio. So this is, right here, these two things are two of the most important things as far as ratios go. And what do we want these ratios to be? We want your working capital ratio to be for sure greater than 1, and it depends on the industry, but usually you want it to be greater than 2 even. That you have 2 times as many assets, well, no, second. This one, greater than 1, and this one greater than 2, that you have twice as many current assets as current liabilities. You want this number to just be a positive number, that you have more. Okay. Okay, long-term liabilities. Also, up in here, we have a thing called deferred income taxes. This is usually a tax, some kind of tax difference in your book taxes and your IRS taxes, deferred income taxes, that you're getting some kind of, you're able to have more expenses with the IRS than you are on your books, yeah.
Deferred, is that the same thing as like a deferment?
It's kind of like you're deferring paying taxes until later. You're not paying it now, you're
I just
deferring.
didn't know what that exactly meant.
It does,
So it's
like
you're delaying,
delaying.
like, so if a kid took out a student loan.
And you defer your loan, you're
defer your
paying it
loan
later.
throughout the time that you're in
Yeah,
school.
right. It's kind of the same thing as that. You're delaying paying your taxes. Yeah. Okay. So under long-term debt, you might also have mortgage payable. It might, I mean, this is a long-term payable. Mortgage payable. Mortgage payable just means you're borrowing money to buy a building. And what you're borrowing is called a mortgage. Okay. All right. Now how are we doing on time? We're almost done. Okay. On equity. We have capital stock can either be common stock or preferred stock. So capital stock can be either one of these two. And these are put on the books at par value. Par value is a low value that the company decides at the beginning, whenever they form the company, that they're going to just value them at $1 or $10 or something like that. Anything that someone pays more than the $1 or $10 is called additional paid in capital. Okay, so I'm not writing that all out, but it's additional paid in capital. That's what you pay over and above the par value. So those two things are separated out on the balance sheet, the par value of the stock and the paid in capital. Now, also in this section we have retained earnings, which, retained earnings is the accumulated earnings of the company that have not been paid out in dividends. Remember, because retained earnings is the beginning balance plus net income minus dividends equals the ending balance of retained earnings. So that's retained earnings is accumulated from the beginning of the company that hadn't been paid out in dividends. And then remember we have other comprehensive income. And this is a term that we haven't talked about, probably, treasury stock. What is treasury stock? That is when a company buys back its own stock. So McDonald's, let's say, has some extra cash and they decide to buy McDonald's stock. I think you're wondering, why would they do that, right? Well, because they have excess cash, they're tired of paying dividends, and they feel like they could just buy that back and not have to keep paying dividends. Okay? They needed that stock. They issued that stock because they needed the money. Now they don't need the money anymore, so they're just buying it back. And then they put it in their treasury. That's how it gets its name. They put that stock back in their treasury. And then there's also the minority interest. So that's the last thing on the balance sheet. And next time, we're going to talk about statement of cash flows.